Dr. Babasaheb Ambedkar Open University.
Welcome to my dear student to Dr. Babasaheb Ambedkar Open University, Ahmedabad, in Chaitanya studio of Dr. Babasaheb Ambedkar Open University, Ahmedabad. In the video lecture series for the course BBA, regular in the subject called Management Accounting, block number 4 in unit number 2, Flexible Budget. So let's begin our session with the learning objectives. The first learning objectives over this video, that is you have to learn that classification of cost, then method of constructing a flexible budget, then my dear friends, utility of flexibility, or we can say the flexible budgeting. After that, at that point of time, in an introduction point, the management will adopt a fixed budget when it is possible to forecast sales, revenue and expenditure with reasonable degree of accuracy. Under this method, budgets are prepared for the different departments of a business on the basis of fixed level of activity. For example, if it is possible to forecast with the certainty that sales during the next year would be the 1 lakh amount, or we can say the 1 lakh unit, it's a 1 lakh unit, not in a amount, then sales budget, production budget and material budget, etc. may be prepared according to that particular unit, or we can say the quantity would be prepared on the basis of this sales estimates only. The cost and output associated with any other level of sales is not considered, and estimates are made only for the single, or we can say the signal, or we can say the single level of the business activity. And now I use the word signal and single. That is a two different words. The single and signal. According to my knowledge and according to my perception and my point of view, I can say that this is the one budget where the all other budget signals are combined. And the single, this is the one single level business activity over it. Then my dear friends, but when accurate forecast of sales and the revenue are not possible, at that point of time, demand for the product is uncertain. And for any reason, the level of production is unstable, which is not stable during that budget period. And management will make use of flexible budgeting at that point of time. So my dear friends, I can say that the flexible budgeting is very important while you defining other level productions level also. And according to me, according to my knowledge, according to my perception, it is the one single level business unit activity. And ultimately it produces all the signals over it. Yes or no, my dear friends? Next is the Chartered Institute of Management Accountant of England defines that the flexible budget as the budget which is so designated, or we can say the design that it change with the level of activity actually attained, and keeping the view of a differential of or we can say the difference of the fixed, semi-fixed and variable costs. Recently it has defined it as the flexible budget is a budget which, by recognizing the different cost behavior pattern, is designed to change as a volume of output changes. So I can say that our the three cost element, that is a fixed cost, variable cost and semi fixed and variable cost, which is designated and designed and appropriate in this manner, and at that point of time we prepare the flexible budget over it. So my dear friends, the main object, or we can say the main point that follow about the flexible budgeting from the above definition that we defined, that the first point is that it is so designed that it change with the level of output actually attained. And from the very beginning, it determines the total cost and per unit cost at a different level of production. The second most important point, as per the definition given by the Chartered Institute of Management Accountant of England, that is, to prepare flexible budget, costs are divided into the three categories. The first category is a fixed cost, second is a semi-fixed or semi-variable cost, and another is a variable cost. So I can say that this flexible budget ultimately defines the three costs. Which cost, my dear friend? That is a fixed cost, semi-fixed and semi-variable cost, and variable cost. Third important point, that under the flexible budgeting method, the departmental wise, or we can say the department wise estimation or estimates are laid down for various level of activities. For example, estimates of the material and the labor cost, etc., are given for the production of rupees, or we can say the 50,000 units, for 60,000 units, and 75,000 units, and so on. So that's why the level of activity at a different level. At that point of time, you have to pronounce or you have to prepare that the flexible budget over it. The next point is that, my dear friend, the classification of costs over there. One of the important point in the flexible budgeting, that is a classification of cost. So there are mainly three types of cost over it. The first is fixed cost, second is semi-fixed or semi-variable cost, and last one is nothing but that is a variable cost, my dear friends. So ultimately I can say that in a flexible budget, we determining these three costs appropriately. Now let us examine what is fixed cost. The first fixed cost, that is, there are the costs which remain constant whatever may be the level of production. The total fixed cost unaffected by the change in the level of production. And for instance, if monthly salary of the manager is rupees 20,000, he must be paid this sum whether the production is 2,000 unit, 3,300 unit, or 6,700 units. So it must be remembered that it is the total fixed cost which remain constant and not the per unit fixed cost. In fact, since total fixed cost is a constant per unit, the fixed cost decreases with the increases in output. And for example, given the above, that the salary cost per unit will be rupees 10 when 2000 unit, and produced rupees 8 when 2500 rupees, 5,500 units, and for that rupees 2 when 10,000 units are produced. So whatever the changes in a unit, in a production, that is not affecting your fixed cost. Fixed remain always fixed. In short, we can say that while the total fixed cost does not change with the production per unit, fixed cost does change with it. But in opposite direction, secondly, it must also be noted that it is only in a short run that some costs are fixed. In the long run, all costs are variable. For example, factory building may be expanded and assistant manager may be appointed in order to increase the output by the 100% over it. The next cost is, that is a variable cost. There are the costs which change with output. Direct labor cost is an example of a variable cost because it increase when output is increased, it decrease when output is decreased. So generally the direct material cost and direct labor cost increase in the same proportion as output. When output is increased by 100%, direct labor cost also increase by 100%. And costs associated with the sales are also of this same nature. The salesman commission, for instance, is linked to the volume of sales. So it increase with the volume of sale, while the total variable cost change with the output per unit variable cost remain constant. For example, if per unit labor cost is rupees 5 and total production is 1000 unit, then the total labor cost will amount rupees 5000, that is 1000 unit into rupees 5. But when the production increased to the 2000 unit, 1000 to 2000 units, then the total labor cost will increase the 10,000. Per unit labor cost will always constant in nature. Direct material cost, power cost, etc. These all are the variable cost. And our other examples of variable cost, such as a cost can be reduced even if the short run by controlling them. So this is what, my dear friends, about the variable cost. The next is semi-variable cost. There are the costs which are partly fixed and partly variable. The depreciation of machinery is an example of semi-variable cost. To the extent machine work, they get depreciated, but even when the machines are out of work, their value declines with the passage of time. And another example of semi-variable cost is the telephone bill. The part is fixed, and another, if you beyond your the particular fixed portion, then it will be chargeable. So ultimately it's a semi-fixed and semi-variable cost. Then a part of this bill represent the rent which is fixed in amount. But if the phone call exceed the definite limit, a certain change is collected per phone calls. Now there are the difference between the fixed cost and variable cost. The fixed cost does not change with output, while the variable cost increase or decrease with the output. Then the total fixed costs are always constant, but per unit fixed cost declines with the increase in output, while per unit variable costs are always constant, but total variable costs increase when output is increased. Then the fixed costs are linked to the period of time and not to the level of output. And the fixed costs are not fixed in the long run, while the variable costs are linked to the level of output and not to the period of time. Then the fixed cost cannot be controlled in the short run, while variable costs can be controlled in a short run and can be economized thereby. The next classification is that the method of constructing a flexible budget. So there are mainly three methods over it. The first method is that tabular method or multi-activity method. Second is a ratio method or formula method, and third is a graphical method and or a charting method. In that, the first tabular method or multi-activity method, under this method estimates are given in the budget for the different level of production and sales. The different level associated with this level of productions are given in a column. Two problems are the vital importance here. The first problem is with regard to the determination of measures. And generally, my dear friends, the budget estimates are expressed in the term of money or physical unit. But sometimes they are expressed in the term of man hours or machine hour too. The second problem is related to determining the level of activity for which the budget estimates are to be prepared. Generally, a few level around the anticipated activity are chosen for this purpose. For example, if the management hopes to reach 80% activity during the year, then the budget would be prepared also at a 60, 70, 80 and 90% activity. The next is the ratio method or formula method. Under this method, the budgets are an average level of production is prepared. On this basis, all costs are estimated for each unit level of a production. For example, if the variable costs are rupees 60,000 at the level of 60%, the same will be 1000 at the level of 1%. In this way, the ratio will all kind of cost at the unit level of production are obtained, and this ratio help to find out the possible situation at any level of production. For example, if at the level of 60% production, the fixed costs are rupees 70,000 and the variable costs are rupees 30,000. Then the variable cost at the level of a 1% production will be rupees 500. If the budget is to be prepared at 80% production level, then it will be the fixed cost is 70,000, the variable cost is 80 into rupees the 500, that is 40,000, and the total cost is 70 plus 40, that is a 1,10,000. This is how the cost and the income can be estimated for any level of production, and it is of course necessary to find out in advance different ratios and actual cost, and also with the help of formulas. Next method, that is a graphic methods and or a charting method. Under this method, the estimates of budgets are presented graphically. First of all, the costs are divided into the three classes, that is a fixed cost, semi-variable cost and the variable cost. Then the figure of the cost are obtained of a different level of production, and for this figures are represented in the form of a graph. The production is measured on the x-axis while the costs are measured on the y-axis. A glance at a graph is enough to find out the figure of estimates for any level of production, and this graph remembers or resembles the break-even chart in which the variable costs are curve is drawn in a place of a sales curve. The fixed cost line is a straight horizontal line and the total cost curve line above that both these curves. The next is, my dear friends, the utility of flexible budget. Under the fixed budgeting method, controlling of a business operation becomes difficult when the actual performance differ from the performance targeted in a budget. Suppose a budget is prepared on the assumption that sales would be the order of, we can say, the 60,000 unit, and during the budget period, but suppose actual sales touch the figure of 90,000 unit. In that case, the comparison of actual with the estimate, it's the meaning that the no judgment can be made about efficiently, or we can say the efficiency of operation of a business unit. To make the comparison meaningful, budget estimates will have to changed. As against this, the budgets are prepared in advance for the different level of sales under the flexible budgeting method, so that any actual result can be accommodated in the budget, making the comparison of actual achievement with budget targets meaningful and lively. In fact, flexible budgeting represents a collection of various budgets associated with a various possible level of business activity. So it does not content with just a single budget associated with just a single definite level of business activity. Therefore, the flexible budgeting can reveal the management about will be affect the change in actual sales and production on the cost and the profit, and it is helpful to those officials also who are in charge of the preparing budget reports by comparing the actual with the budget estimates, and thus the management gets figures ready in the budget whatsoever may be actual level of activities. Thus we can say that flexible budgeting seems to be the extremely beneficial to the management. In fact, however, it is too difficult to practice, but flexible budgeting necessitates a classification of the cost into the fixed cost and variable cost, and we can say the semi variable and semi fixed cost also, and this is not an easy job, my dear friends. On that basis, let us examine that one illustration. With the following data for the 50% activity, prepare a budget for the production at 80% and 100% activity or capacity. You have the data with respect to the 50% of activity. On that base, you have to acquire the base at a 50%. You determine the activities or classifying the capacity with respect to 80% and 100%. Over it, the production at a 50% activity is a 500 units. Material per unit, that is 100 rupees. Labor per unit, 40 rupees. Expenses per unit for 10 rupees. Factory expenses 40,000. In that 40% is fixed, so 60% is variable. Administration expenses rupees 30,000. In that 60% is fixed and 40% is variable. So on this particular example, or we can say the illustration, you have to define the activity level at a 80% and 100% also. So I can suggest you, while you referring it and while you preparing the flexible budget, at that point of time you prepare three activities, that is a 50% activity, at 80% and at a 100%. So for it you just assume it and you classified it in an easy manner. This is the answer of it, that is a 50% activity, 80% and 100%. Let us examine the total cost. Well, the total cost is defining that the direct cost, that is a material, labor and expenses. Material at rupees 100, then labor at rupees 40 and expenses at rupees 10. And variable factory overhead, that total is 40,000 and 60% is, what is, my dear friends, that is 24,000 divided by 600, that is we can get the 40 rupees per unit. The units are defined, 500 unit at a 50%. So kindly put a formula that at a 50% level 500 units are over there. Then what is about at 80%? So you will get 800. Then at 100%, so it is 1000. So unit is defined at that point of time, you just multiply it with the price. So material at rupees 100 per unit, that is 500 into 100. So you will get 50,000 at a 50% activity. Then 800 units into 100, that is 80,000 at a 80% activity. Then 1000 into 100, that is 1 lakh rupees at the 100% activity of the material cost. According to it, the labor activities are also there. So 500 into 40, that is 20,000 unit, 20,000 rupees. Then 800 into 40, that is 32,000, and 1000 into 40, that is 40,000 labors at a different activities, that is 50%, 80% and 100%. Then expenses at rupees 10, that is a 500 into 10, that is a 5,000, 800 into 10, 8,000, 1000 into 10, 10,000. So these are the expenses at a 50%, 80% and 100% level. Then after variable overheads, the variable overheads are we defined at a 40%, 40 rupees per unit. So the 500 into 40 is 20,000, 800 into 40 is 16,000, and 1000 into 40, that is 40,000. That is your variable fixed overhead. Now the question is, sir, variable is there, so what about that fixed? So my dear friend, fix is on that basis. You just determine that fixed cost, that is a factory overhead, 40,000 into 40%, that is 16,000, 16,000, 16,000 in all activities. Fixed cost remains unchanged. It is constant. Accordingly, variable administration overheads are there. So that is 30,000 into 40%, that is 12,000 divided by 600, that is a 20 per units. And accordingly you multiply it, that is 500 into 20, 10,000. 800 into 20, 16,000, and 1000 into 20, 20,000. And the fixed administration overhead, that is a 30,000 into 60%, that is 18,000 in all respective activities, that is at a 50%, 80%, and 100%. So according to that, you just total up, addition that particular level of activities like a variable cost. At a 50%, you just calculate or add 50,000 plus 20,000 plus 5,000 plus 20,000 plus 10,000, then you will get 1,05,000. At a 80% activity, you have to just justify and the addition of that 80,000 plus 32,000 plus 8,000 plus 32,000 plus 16,000. So you will be get 1,68,000. After it at a 100% level, 1 lakh plus 40,000 plus 10,000 plus 40,000 plus 20,000. So you will be get 2,10,000. So this three amount, 1,05,000, 1,68,000 and 2,10,000, these three amounts are nothing but your total variable cost. Then after you just add that two fixed cost over there, that is a 16,000 plus 18,000. Then 16,000 plus 18,000, 16,000, 18,000 with these three types of activity. That is 1,05,000 plus 16,000 plus 18,000. So you will be get total cost is equal to 1,39,000. Then 1,68,000 plus 16,000 plus 18,000. So you will be get 2,02,000. 2,10,000 plus 16 plus 18,000, that is 2,44,000. So these three are your total cost. So in that we defining what? The fixed cost and the variable cost over it. So ultimately we prepare the flexible budget at this three level of activity, that is a 50%, 80% and 100%. So this is, my dear friend, flexible budget. After watching this video and after evaluating or calculate this particular illustration, you have to justify and evaluate yourself with the three aspects. First is you have to write the long questions over it. Second is a short question. Then multiple choice question. And after, if you want to refer more, then go for the another books also, that is reference book. So let us examine the first aspect. That is a long question. The first long question is describe the utility of a flexible budget, and second question is that describe the method of constructing the flexible budget over it. The second aspect, that is a short question, is define the fixed cost and define the variable and semi-variable cost. Third aspect is to define the multiple choice question. That is, first multiple choice question is management will adopt the fixed budget when it is possible to. So answer is a forecast budget, forecast revenue, forecast expenditure with the reasonable degree of accuracy and all of the above. So answer is forecasting of the sales. The second multiple choice question is that if it is possible to forecast with the certainty that sales during the next year would amount to 1 lakh units, which type of budget would be prepared on the basis of sales estimated? So ultimately we can prepare the sales budget also, production budget also, material budget also. So all of the above is answer. Then after, if you want to refer something more with respect to this particular subject or this particular unit, So you may refer these 3 books over it. So hope you learn well in this subject. Hope you enjoy it in a good manner. Thank you very much, my dear friend. We will meet in the next session. Thank you.